Securities and investment advisory services offered through ING Financial Partners, member SIPC. Magellan Planning Group is not a subsidiary of nor controlled by ING Financial Partners.
It's time for the Magellan Planning Hour with Kevin Meaders, brought to you by Magellan Planning Group. For estate, financial, and tax planning, visit MagellanPlanning.com. Tune in with Kevin as he shares his wealth of knowledge about sound financial investment and preparing for retirement. And now, your host, Kevin Meaders.
Okay, everybody, thank you, and welcome again to the Magellan Planning Hour. This is Kevin Meaders, your host, President and CEO of Magellan Planning Group, also certified financial planner and a Georgia attorney, with my Ed McMahon here, which is Lynn Bittner, also my law partner at Magellan Legal. And we have a nice guest today. I say nice, I've known him for quite some time here, Dan McKenzie. And Dan is with Options Mortgage Services. And Dan, tell us a little bit about you and where you're coming from.
Our company was founded in 2006, and during the mortgage changes that have gone on, we decided to keep ourselves small and remain as a broker so that we can get our clients the best possible products out there. And that's why we're going to talk about reverse mortgages today.
Yeah, and so I just want to break in there quickly to say that, Magellan Planning Group, and what we're doing there is putting the legal, financial, and tax perspectives all together in one place. And one of the things that we do when we run into retirees that may be questionable as to whether or not they're going to outlive their resources, their financial resources, sometimes we end up talking about reverse mortgages. And I know there's a lot of confusion out there in terms of, what a reverse mortgage is and how it works. And I'll be quite frank with you, I don't know all the ins and outs of them. So that's why we're having you here today. And so let's just start with the basic reverse mortgage. And I think, the way I've sort of seen it work in the usual fashion is, you have a widow that's usually in a home somewhere maybe, and the obviously the husband's passed away and she's living a lot longer than they ever expected. And maybe she still has payments on the house, or, maybe there's an illness, or
maybe just a short cash flow every month.
Yeah, maybe there's a short cash flow every month. She's living off, or she has some medical needs, and the expenses of that are higher than they otherwise, need to be. And so we run into that. What is your typical, when you see your typical reverse mortgage client, let's say?
A typical reverse mortgage client really kind of falls into two categories. Number one, they either need cash for some situation, or they need cash flow, as Lynn had mentioned earlier. And then number two, maybe they've got a house payment and they would like to get rid of that so that their fixed income that's dropped, maybe because, for example, one client, 401k, they had been retired since 96. In 06 I did, or in 07 I did the reverse mortgage for them because the 401k funds had drained, were gone. So they were living on a fixed income at that point from Social Security and a small pension that they were getting. So at that time they were making about a $900 house payment, and we were able to eliminate the house payment. Now they still had to pay taxes and insurance annually, but we eliminated that house payment. So the sons and daughters of that person didn't have to make that house payment for them, and they could still live in dignity.
So what do you say the average age is of the people that you work with when you're doing reverse mortgages in general?
They're going to be between 70 and 73. It's not they can start a reverse mortgage at 62, but generally it's not a product that you want to get into that early, because it's kind of like, okay, I want to do a reverse mortgage after everything has everything else is gone by the wayside, and I need that cash out of the house.
So everything else, and that's the way we use a reverse mortgage, as sort of our last ditch attempt, basically.
Exactly.
I mean, when everything else is gone, that's the last place that we go. And then usually that means that they can stay in their home and then stop paying payments on their house if they are, to take cash out to help, help
exactly what is a reverse mortgage, Dan?
Reverse mortgage, the technical name for it is a home equity conversion mortgage. And basically, It allows the homeowner to access equity in their home and never make a payment on the home as long as they live there. And I think that's the key that what makes the reverse mortgage work. In a forward mortgage situation, which is what we all are accustomed to hearing about, 30-year fixed mortgage, every time you pay $1,000 against that mortgage, you're paying some part of the principal down. So if your principal starts out at $100,000 and you make a payment one month, the next month you owe $99,900. On a reverse mortgage, it's reverse of that. So every month that goes by, you do not make a payment. So you don't have to make a payment the first month, and the balance on the principal goes from $100,000 to $100,100 or whatever after the first month.
So so I've got a paid up house, a $300,000 house. I'm retired. I'm 70, and I just want some more cash flow. What is that? How do the numbers work with approximately with a $300,000 house that I've paid up?
On a $300,000 house, and there are multiple ways that you can get the cash flow stream, okay? But on a $300,000 house, the one of the most popular ways is a lump sum. But on a $300,000 house, say you're 72, you're probably going to get about $160,000 in cash out of it and not have to make a payment as long as you live there.
And what about if I want a monthly?
There are two different types of monthly that you can get. You can get what's called a tenure. And in the financial world, you guys are used to that being an annuity. The tenure is much like an insurance payment that is for life. So, say...
are you saying 10-year or tenure?
Tenure. Sorry. Yeah. So anyhow, the tenure payment, for instance, I just helped a gentleman with a loan. His house was worth about $225. He owed $50 on it, so he was netting out about $80,000, a lump sum payment. The tenure on that would have been about $560 a month as long as he lived. That's the tenure payment.
So there's a risk on that for the purchaser, I suppose. I mean, it's like an annuity, but if he lives to 100, he keeps getting paid by whom?
He keeps getting paid by the FHA HECM mortgage servicer. All of these loans are insured by FHA, Federal Housing Administration, HUD.
So you can get like an annuity. You can get like a lifetime income stream.
Part of the closing cost is mortgage insurance, upfront mortgage insurance, and monthly, and that's what tries to cover that. So, much like an insurance annuity that you guys sell that does the same thing, that tenure payment does the same thing.
So it's government backed.
Yes.
And you are saying tenure, Tenure.
Tenure.
Okay.
TEN. Thank you, Lynn.
It's a British accent.
I got it.
I'm from Boston.
Yeah.
Well, you're in the right market.
Okay. All right. So I think we're just trying to get our brain around this. You're saying a reverse mortgage is like a forward mortgage, but you're either getting money out lump sum, or you're through that calculation. I guess they're coming up with a lump sum calculation, and then they're working backwards, and then there's the possibility of getting it sort of an annuity payment for life.
Yeah.
Or how else can the annuity payment be structured? I mean, because I think a lot of people, when they hear that word annuity, we did a show on annuities a couple of weeks ago, and we talked about there was really 4 different annuities. There's the deferred annuities and the immediate annuities, and what we're talking about here with the tenure payment, I believe, is the immediate annuity. It's the annuity that pays you as long as you live, and then if you die early, what happens?
What happens if we die early? Okay.
Right, yeah.
I was kind of going to get back. There are multiple ways to get the cash out, and we've just really talked about 2, lump sum and tenure.
Okay. Well, because I think that's where a lot of the confusion arises. Kind of like with annuities, the confusion, in my mind, the thought was most people think, well, I live in my house, I get a monthly payment maybe, or I can stay in my house for as long as I live. But then if I die, then everything that I have there is just gone. In other words, if I die early, everything that I have is gone.
And this is not the case with the reverse mortgage. With a reverse mortgage, that's a great question, and this is where the biggest confusion
Were they
comes
ever
in.
like that? Were they originally like that, perhaps?
No, when you do a reverse mortgage, you still hold title to that home. That is an asset that you will to your heirs, or that you may want to move and sell it. You can sell it just like any normal property that you own. You still own the asset. Now, at the end of the day, as a great example, my initial person I was talking about in 2007 got a reverse mortgage, $118,000. For them, it was payment abatement. They did not have to make a payment anymore. Okay, they got about $700 cash at the closing. Fast forward to now, they passed away this year. They owe $136,000 on the house. So that home now to that heir that received it can turn around and sell that home for whatever, hopefully more than $136,000, and still reap the benefits of that. Now, of course, in this market, that home's probably worth about $145,000 now.
But so it doesn't just disappear.
No,
There's something left, perhaps, to deal with for the heirs.
right. And I know we're about to get into a new segment. There's about 6 different ways that the money talk about how the money can be handled once you get it, and we'll do that in the next segment.
Okay, we'll handle that in the next segment. So, what we've been talking about here is something that is not so well known. I guess the words have been thrown around quite a bit, but it's a reverse mortgage, and we're talking with Dan McKenzie and Lynn Bittner here on the Magellan Planning Hour at News Talk 1160, the talk of the town. We'll be right back.
And now, back to the Magellan Planning Hour with Kevin Meaders. For estate, financial, and tax planning, visit MagellanPlanning.com.
Okay, everybody, welcome back to the Magellan Planning Hour. I'm Kevin Meaders, Lynn Bittner here too, and we're interviewing Dan McKenzie with Options Mortgage Services. Options Mortgage Services, you can reach them at 678-482-1578. 678-482-1578, and we're talking with Dan McKenzie, and Dan is the man when it comes to reverse mortgages. He's been doing them, and he's done some for his family, and so that's why we felt like we would bring him on the show to talk about something that is kind of confusing, not very well known, sort of new. And Dan, how long have these reverse mortgages have been going on in the economy?
Well, I did my first reverse mortgage in 2007 for my mother. And she just passed away this year, so I'm living the reverse mortgage example right now. And I be honest with you, I'm not sure when reverse mortgages started. I'm going to guess somewhere in the 90s.
Probably in the 90s because, in the 80s, it was like kind of in the 80s and the 90s when medical science started, extending longevity. Because that's really what it's about here, again, is the longevity of people. I mean, Americans are living much longer than we ever thought. I know when my grandfather retired from Amoco, he was 65, and they gave him a rocking chair and a nice watch, and he used the rocking chair, incessantly for 3 years, and by the time he was 68, he no longer needed it. He was gone. And my grandmother, though, on the other side of that coin, is turning 98 this May, or May and June. So people are definitely living longer, and I think that this has been a direct result. The reverse mortgages have been a direct result of the longevity of people. And so, yeah, I know that more and more it's something that we look to, especially as medical expenses increase. And especially if people have refinanced and took money out. Do you see that any from the back in the 1% LIBOR days when people took money out and now they're just distressed?
The thing about the reverse mortgage is the couple of qualifiers is a lot of people call me and they think that they can get all the money that their house is worth out of it. Part of what makes the actuarial tables work on a reverse mortgage, for lack of a better term, y'all probably know it. Anyways, part of what makes that work is an individual that's maybe 72 years old or so. I keep going back to that 72-year-old because that seems to be the mid-range time of when people start looking at a reverse mortgage. That individual is going to be able to get about 50 to 55% of the value of their home out, not 100%.
Okay, so that's a big difference. I mean, that's a big variable there.
But
Correct.
the value stays in the house for the heirs, is what I think I understood you to say before.
Yes, the house. Then the house can go to the heirs once they pass. So for instance, take my mother for example. 70, perfect example. In 06, she was 71. We got a reverse mortgage for her because her 401k had dwindled to nothing. And she was going to be on Social Security and a small pension from a company she worked for in the 60s that found her. Imagine that. And so we were talking about $1,800 a month here. She was making an $800 a month payment. You can easily do the math and see that while a single person doesn't have that many expenses, that leaves her $1,000 to eat and watch TV and
Pay the bills,
utilities, So what we were able to do is we did a reverse mortgage for her. She owed $112,000 at the time on the home. So with the cost of a reverse mortgage, the closing cost, which the biggest portion of that is the mortgage insurance to ensure that the payments can continue to be made on it. We ended up doing a mortgage for $118,000. Okay? So fast forward to now. She passed away last year at
She took that as a lump sum?
Yes. Okay. Lump sum being this. She owed $112. Okay. The closing costs were about $6,000. So 112 and 6, 118. When what happened is the lump sum that came was used to pay off the current mortgage, so there would be no payment from that.
So it was a wash for her. She just she stopped making payments.
Her lump sum at the end of the day was $700.
Got it.
Right, but the important thing though is that she had income of $1,800. She immediately was $800 going out the door to pay for the rent or the mortgage, right?
Right.
And then at the end of the day, what you did for her was you got rid of that payment, but she still gets to live in the house for the rest of her life.
Right, and never make a house payment.
And never make another payment.
Yeah.
And if her house had been worth $300,000 or $400,000 and she owed the $100,000, she could have done both. Got rid of the payment and had a monthly payment also.
Correct.
Is that something that, with a regular mortgage, do you have to get an appraisal and that type of thing usually?
Yes.
Is that part of the closing cost?
That's a good question. I'm glad you asked that because everybody goes, what's the qualifications? Right now, you qualify for a mortgage. We got income, we got credit. How much assets do you have? What's the value of the property? With the reverse mortgage, the only thing that matters is what's the value of the property. They don't have to be employed because they're not going to be making a payment, and we don't care about their credit score. And we do care about the condition of the home, however. So the home, the asset, is the big thing.
Do you even pull the credit?
Actually, the credit is pulled now. We didn't back in the past, but now credit's pulled. But it's just to see where they're at. There's there's nothing there for qualification.
Not part of the formula.
And you don't look in the health or any of that either.
No.
As far as thinking about the longevity, you just take whatever age it is and use the tables.
Yeah, none of that. So,
okay.
Anyhow, very easy to qualify for in that respect.
Is that just a straight line 50%? So if I have a $300,000 house and say it's completely paid off and I want to get, I want to do a reverse mortgage on the whole thing, am I looking at just a good rule of thumb, 50% roughly, or is that the bright line rule? I mean, or is it
50% is a good rule of thumb, and it's based on age. So if I'm 62 years old, I may be 40%. If I'm 78, I may be 55%.
Oh, really? So
yeah.
Age comes into play when you're thinking about the payments. Okay, it's interesting to hear.
Yeah, think about it. We're betting on somebody, but they're betting on somebody living to a certain age. So
it's completely age based. So someone, but then as you say, the
age and property.
Yeah. So as you say though, that it's not like a strict annuity where if you die early that you've lost everything. They just take the balance that you've basically spent, right, and subtract that from the value of the house, and whatever is left goes to your heirs.
Correct.
Now, how do they do that? Does that just go through a will, or do they have like a beneficiary designation at the end of this on the reverse mortgage?
It is just like any other home that your parent would own when they pass away.
Goes through the estate.
In their will, it goes right into the estate.
And in your case, though, your mom, just to finish the numbers that you were talking about, the company stepped in and paid off the 110 or 20, whatever you said, and now the house is worth, what, a couple hundred?
The house, at this point, because of our last 5 years in the mortgage business, the house is worth about $148,000.
And so you as the heir would have to repay the 120 or so that was paid in, and so you've got whatever's left over is the asset.
I mean, here's the exact numbers. Here's what went on. I called the reverse mortgage company. I said, my mom's passed away. It goes into their process at that point. And we owe $137,000 on the house now. So they actually sent an appraiser out to see what the value of the house is. Now, how
come it was up to 137? Because there were interest being added on?
The interest from 118 to 137 for 7 years of her living there.
There's an annual interest. Okay, that's interesting.
You with me?
Yes.
So that's reverse. If she had been making payments all that time, she'd have owed $80,000 or whatever.
Gotcha.
Yeah. So anyhow, that's making sense. So here's the real numbers: $137,000. They pull an appraisal, so it's worth $136 in August. The housing market right now is doing crazy stuff, and that there's no inventory in that price range. So I actually listed it with a real estate friend of mine, and we actually got cash offers in from investors for $142,000, one for $150,000 that actually fell through. Now I have a contract on the home from a buyer for $147,000. We believe it'll appraise. By the time I pay all the cost of sale, I'm going to walk away with about $2,000. Suppose that I didn't want to do all this work to make the $2,000. What could I have done? I could allow the mortgage company to foreclose on it, which is extreme cost to the mortgage company, or I can just sign a deed in lieu over to the mortgage company and they take the home back. Of course, it's no reflection on my credit. It's just simply with the estate. So even if the estate was worth $1 million, which it is not.
I mean, you were just acting as the executor in the estate, right?
I'm just acting
as the executor. You have the option of the estate paying it off and distributing it, or just letting it go back to the mortgage company.
Correct. And letting it go back through a deed in lieu is the cleanest way.
And if it was a family home, for example, and the kids wanted to buy it back, they could do that too.
Either way, the mortgage has got to be paid off within a year.
Okay. Well, we got to take a little break here, and when we come back, we'll talk more about reverse mortgages with Dan McKenzie at Options Mortgage Services. This is Kevin Meaders with Magellan Planning Group, and you can learn more about us at MagellanPlanning.com. We're going to take a little break, and we'll be right back. You're listening to the Magellan Planning Hour on News Talk 1160, the talk of the town.
And now, back to the Magellan Planning Hour with Kevin Meaders. For estate, financial, and tax planning, visit MagellanPlanning.com.
Okay, welcome back, everybody. This is Kevin Meaders, and you're listening to the Magellan Planning Hour on News Talk 1160. I'm here with Lynn Bittner and Dan McKenzie, and we're talking about reverse mortgages. Dan's with Options Mortgage Services and has been doing reverse mortgages and did one for his mother and his grandmother. So he has been doing them for the family and with folks all over Georgia. So Dan, we had talked about the typical example of someone getting a reverse mortgage when they're, say, I don't know, late 60s, early 70s, and maybe they have a mortgage, maybe they don't, but then the end of the result is that they get a lump sum, and then they can continue to live in the house for as long as they live. And then we also said that in the other option, instead of getting a lump sum, is to do the tenure, which is kind of like an annuity payment or like a monthly payment. Does that monthly payment last as long as they live as well?
Under the tenure example, it does. There's really 6 ways that they can get to the money that is available in their home once they do the reverse mortgage refinance. Now, there is a reverse mortgage purchase, too, which we'll get into later. But let's talk about those ways that we can get that money out for them. Number one, something that we've been talking about throughout the whole show is the lump sum payment. That's real simple. Okay, I don't owe anything on my house. It's worth $200,000. I'm 72. I'm going to get $105,000. Boom, here's your $105,000. Okay? That's the simple way to do things. The second way that we talked about, too, is the tenure. The tenured payment is a guaranteed payment for as long as you live in the home.
And live in the home.
Yes, you have to live in the home. You have to continue to live in the home or the reverse mortgage becomes due and payable.
So if you go to a nursing home, for example, then everything stops like it would at death.
Right. And it's a primary residence, too. We can't have a second home. We can't have investment property. They got to live there. It's got to be their primary residence. That's something we kind of skipped over.
And if you choose the monthly income stream, and say that the lump sum would have been what you said, 105, which is a rule of thumb, maybe 50% more or less, you can sort of think about. Is the monthly sort of a percentage of the lump sum that you can make a rule of thumb?
The tenure is obviously based on. Remember, I said there's 6 ways. We've just talked about 2, really. The tenure is really based on the idea of money for life. So that's going to be the lowest payment you can get. On my example, you're looking at probably about $560 a month for the rest of your life.
Instead of the 105.
Correct.
Okay, at around 70.
So let's talk about term. I had a gentleman. He said, "Dan, I need $2,000 a month out every month." Okay, no problem. You can get the $2,000 a month out, and they just say you get that for 10.6 years or ever how long until the money runs out. So that's 50 periods. If we just do a straight line calculation, that's 50 periods. Of course, they're going to take into account the time value of money and the cost. Mm-hmm. Let's say he passes away 1 year after he's been taking $2,000 a month out. Instead of owing $105 on the reverse mortgage, he's only going to owe what he drawed out.
Got it.
Or what has been drawn. Mm-hmm. The other way that you can take the money is as a line of credit, and it can just be sitting there. Hey, this is my safety valve when I get to be, obviously you want to wait until you're older to do it because you can get more than 50%. But this is my safety valve. I got it sitting over here. Oh, car tore up. That's out of my budget. I'm going to pay for that. Oh, air conditioner broke. Going to buy that.
Does that accrue interest while it's sitting?
No, as long as it's not used, it does not accrue interest. Just like a line of credit you would get on your home now.
Well, that was what I was going to ask you. What's the difference between that and a line of credit really? You just never have to pay any interest at all.
Correct.
You never make any payments or ever pay any interest at all. It just accrues.
Yeah.
Until you die. The
idea being, the only difference between that and a bank line of credit is when you draw on the bank line of credit, you get a payment coupon. You owe us $257. So then you can either start taking the money from the line of credit to pay the line of credit, or you can do the reverse mortgage and never have to make a payment.
You can just draw down.
Just draw down.
And as you use it, it adds interest to the balance of the house the heirs have to deal with.
Correct.
Got it.
And then the other 2 ways are basically modifications of everything else we just talked about. Okay, Dan, I need $500 a month, and then I want that to last. Let's say modified term. I need $500 a month, and but I want to hold back $50,000 in my line of credit. So, okay, you're going to get the $500 a month for 4 years or whatever, What is 500 into 50,000? One of us math geniuses. You're going to get it that long.
You're the one who went to tech.
Right, I went to tech. So I've got a human calculator in here. Right. So anyhow, that should be 100 periods, right? So 100 periods, whatever that is, 100 months.
Okay.
Divided by 12. Anyways, and then the other 50,000 lays in a line of credit for those emergency expenses.
Okay.
Then we can do modified tenure, where you say, okay, I want $300 a month for the rest of my life. How much can I have left in a line of credit if I only want 3 instead of $550 or whatever? Because we're gonna give you a tenure amount that says, hey, okay, this is the rest of your life, $546. Well, what if I only want to take $200? What can be my line of credit?
Gotcha. Now, I got to say, Dan, when I'm sitting here and I'm using my certified financial planner brain, I'm thinking, okay, well, what are my other options? Because I could take the money as a lump sum, and then what I would do is say, let's just say that really I wanted to do this 10-year thing, and I wanted a lifetime payment, okay? Well, I would take the lump sum and shop around different annuity companies to see if I could get the highest annuity or a higher annuity payment from maybe a commercial annuity company rather than the mortgage company. Have you compared those in terms of like when you're with your mom or your grandmother? Did you guys maybe possibly think about that and compare it to just a commercial annuity?
I haven't done that. That's kind of why I'm here with you, so that you can take a look at that sort of thing for your clients when they come to this point. Financial planners are the biggest gate opener that we have for reverse mortgages, because they're looking at these finances and trying to help these folks live a comfortable, happy life. And if that product exists for you guys out there that could provide them with a higher cash flow, by all means, that's what I would do.
Yeah. Well, I got to tell you, in my planning practice, I've been relatively resistant to recommend reverse mortgages because, not because necessarily of anything else besides, there's interest that's involved, and you got the interest rate. We haven't talked about interest rates yet, but I want to do that. And then you got, like you say, you got the fees and the different things, the closing costs and all that stuff that goes into it. And as a percentage, I haven't really shopped around a lot, but as a percentage, it looked pretty hefty in terms of doing that. But you said on a $100,000 house or a $200,000 house, the closing costs or something on that along those lines would be about $6,000.
Yes. Let's take a real world example.
Okay.
All right. That is why. First of all, the reverse mortgage is not. I guess compared to other mortgages, the reverse mortgage is not what I would consider to be a budget product. Because closing costs wise, let's take this example, and a lot of the closing costs are based on the actual price of the home. But let's take this example of a $220,000 house. Total closing cost was, hang on, I'm adding in my head here, boys. $7,500.
Okay.
That include the insurance that you talk about?
That's the mortgage insurance, the MIP. We call them upfront mortgage insurance. That includes the bank costs and then the attorney, the normal attorney and government pound of flesh and those sort of things. So I will tell you this. This fellow was shopping me against one of the national advertised brands out there on TV, and my closing costs were $2,500 less than them, so those advertisements aren't free.
They got to pay Robert Wagner and Fred.
So take a $225,000 house divided by 7,500. What percentage is that? Less than 4.
Three something.
Yeah, I was about to say it's about 3.5.
Mm-hmm. And while we're on there, what is the interest rate now? Is it a higher rate, or is it like down where the real rates are?
That's a great question. I wasn't that concerned with interest rate when we did my mother's deal because, man, in my eyes, I was, I guess, spending a little bit of my inheritance so that my mom could live happily ever after. But but at the same time, you want to maximize the family assets for all generations. So that being said, most of these loans we're doing is an adjustable rate mortgage, okay? Real world example today, this same gentleman that I talked about on the $225,000 house, his real interest rate is a margin of 2.25%, which right now is expected rate of 4.9.
Okay, you said margin, so that's the margin off of prime?
It's a margin off of the LIBOR.
LIBOR, okay.
Yes,
Wow.
So that's the index. Here's what happened with Mom's deal. We started out at about 6. This year, right now, 1.61% this month. It adjusts monthly. The rate does. Index plus margin. 1.61%. That's $200 a month in interest is all that's adding to the principal right now.
All right, well, we got to take a break, and we'll talk more about that, especially Mom's Mortgage. You're listening to the Magellan Planning Hour, News Talk 1160, the talk of the town.
And now, back back to the Magellan Planning Hour with Kevin Meaders. For estate, financial, and tax planning, visit MagellanPlanning.com.
Okay, welcome back, everybody. This is Kevin Meaders, and you're listening to the Magellan Planning Hour on News Talk 1160, the talk of the town. We're talking with Dan McKenzie, and we're talking about reverse mortgages. And quite misunderstood. I got to tell you, I've learned a lot of things. The main thing we've learned here is there's 6 different ways you can get the money out. You got to be within 62. What are the age requirements again, Dan?
62 or older.
62 or older.
You must live in the home.
Got to live in. It's got your primary residence,
Be
right?
your primary residence, and you must live there.
Okay, and then we were talking a little bit about the interest rate, because when you take the money out of the home, you're still living there, but the interest is accruing, right?
Correct.
And then if you die early or you die, right away, the house can be sold. The proceeds from the sale can go to pay off the reverse mortgage, just like a normal mortgage, and then the house could go to the heirs, or it could be sold and paid out to the heirs just like normal. So you're really just taking a loan against your house that's paid back at your death.
It's simply a mortgage on your home. That's correct.
Okay. And what about the taxes on this kind of thing? I mean, I know that that the interest on my house is a big item on my taxes.
The taxes on this, first of all, a lot of people ask, well, when I get the $100,000 out, do I have to pay taxes on that? And the answer is no. The second question is, wow, my interest deduction has been great for me, just like you said. Can I deduct the interest that the loan accrues annually? And the answer to that question is no. However, when the estate is settled, or when the owner sells the home, they can then take that interest right off.
And the lump sum is not taxable.
Correct.
And the monthly would not be taxable either then.
Correct.
Okay.
And
So
keep in mind now, they're not, people that are used to escrowing will still have to pay their taxes and insurance.
Okay, yeah. The taxes are still going
the
to
property taxes.
Yes, property taxes and insurance.
But what about, so if someone does a lump sum, are they still responsible for the taxes?
Absolutely.
And the insurance?
Yes.
Okay, so
it's just like you own your home free and clear. If you own your home free and clear, you got to pay your taxes and insurance.
Gotcha.
People are so used to making in their payment that escrowing their taxes and insurance, they don't think about that.
Right.
Now they're not making a payment, so they have to pay that.
Right. It's like
still needs to be budgeted for.
Gotcha. It's like quarterly taxes.
Right.
But the important thing is that you can take money out of your home, lump sum, and that's tax free.
Either way is tax free. And you still own the home, which is important for people to know.
That's important. But as you were saying to us earlier, there's some danger to taking it as a lump sum.
Yes, I did.
Like lottery winners.
Well, you can imagine that if you've got any
NFL players,
if you've got any friends that all of a sudden came into some money, it appears that they really lost their mind on how to budget. This is no different. If somebody that's been living on a couple $1,000s a month, retired, all of a sudden gets a lump sum of $100,000. You wouldn't believe how many heirs can come out of the woodwork needing stuff, and you got your needy kids and whatnot.
Oh yeah, they're all needy.
So the FHA and the underwriters on this product, in their infinite wisdom, determined that they're only going to allow you to get 60% of this lump sum the first year, and then at the end of that first year, the other 40% is available to you in any one of the 6 methods to come to you.
Like a line of credit or whatever.
Yeah. Now, there's one other thing I wanted to talk about. I know we're in our last segment. You can actually purchase a home with a reverse mortgage, and here's a great example of how that can work. Let's say, for instance, mom and dad have been living in Florida, and they've gotten to a point where they want to be around their grandkids. They miss them. They want climate changes. They have physical needs. They want to be closer to a different hospital, whatever. And they own their house free and clear in Florida, and they sell it for, let's say, $120,000. All right.
Well, where are they living? I mean, Ocala?
Okay, 220. What the?
Orlando proper. I don't know, where they grow all the oranges. Whatever.
Sorry if you Ocalans.
Work with me here, Kevin. So anyhow, so they come up here and, man, they can't find anything they want to live in or a neighborhood they want to be in for less than $200,000. Guess what? For $96,000 out of their pocket, they can buy a $200,000 home on a reverse mortgage.
And never make another payment.
Be in the same situation, be by the kids, be in a bigger house.
Run that by me again. I can sell my old house and have some cash in my pocket and want to buy a new one, but it's twice as much as I've got in my pocket. I can use a reverse mortgage to buy a new house for me.
Yes.
That's news to me. I never heard of that.
Yes, you can.
Run me through that again.
Well, that's really like leveraging your dollars to get about as twice a larger house as you otherwise could.
Right.
Yeah, Dan, tell us. So you sell they sell the house in Florida. They've got $100,000 in their pocket. They want a $200,000 house.
Right.
They can put the $100,000 down as a reverse mortgage. Never make another payment.
Correct.
Pay insurance and taxes.
Mm-hmm.
But other than that, pay no
maintenance. Yeah.
Yeah, but
well, wait a minute. So they find a
that
house.
simple.
They
Freaky,
find a
huh?
house, and they've got an agent, and they think they want to do a reverse mortgage. They call you, and you get in the mix with the regular mortgage people, and
Yes.
that's how people find that they can do this.
I mean, you wouldn't believe the halfbacks. I call them halfbacks. They go down. They come from the north. They go down to Florida. Their kids got transferred to Atlanta. They move halfway back to Atlanta. They got seasons. They got hot summers, and they got their kids, and they get to live in their house with no payment, and it's still a bigger house.
That's the possibilities there.
Or better yet, they sell their house in Ocala for $300,000.
how young do you have to be to do that? 'Cause that's on that's
we're
my
still working
plan.
in that 70, 72 zone.
62. Everybody has to be 62.
Yeah, you got to be
or
at
old.
least 62. You probably gonna have to put a little more down at 62. But let's say they sell the house for $400,000 or $500,000. They're on the canal down there, as Kevin was jesting earlier. Say they sell that house and they come up here and they just want a $200,000, or there's some really nice $250,000 retirement communities with big old 3-foot doors and flat everything and tons of people to go hang out with. They go pay $250,000. They do a reverse mortgage on that for $250,000.
Keep the 400 in their pocket.
Keep the remainder in their pocket.
Kids aren't going to want it anyway.
Good point.
A lot of times you have to sell those
How
back
fun
anyway.
is that? I mean,
That's
a lot of people are wanting to move back by the kids. You know, you want to get away from them at some point. Now you want to get back to
Are
them.
people doing that much, or do people don't know about it?
You know what? I'm trying to be the mouth of the South and tell everybody about that because I don't feel like people are utilizing it that much. And I've had a few clients that I've done this for, and initially they were very resistant. But once I explained the situation to them, they were excited.
So what is the minimum you'd have to put cash into to do a reverse mortgage for a new house? More or less.
I'm going to stick with my 50% deal. I've got an example here that I ran for a $200,000 client, Mr. Smoking Joe Frazier, in the Thriller from Manila. Mm-hmm. Yes, I ran that example for him. Under his best case scenario, he could do a fixed rate loan at 4.99%. And his out-of-pocket to move into a $200,000 house would be $96,691.25.
And let's just
That's
say
closing
if
costs
I
and
have no
everything.
kids and I don't care about my heirs, then I want to live as long as I can, get as much money out of that thing as I can. But I don't really care if the interest rate goes up, do I? Because I'm not.
You really
paying
don't.
I mean, the interest rate's on you guys,
Who cares is us heirs.
right? If I don't have any heirs or I don't care about my heirs, then I don't really care
It's an
what
airy
happens.
situation.
Then I don't care about the. But let me ask you this: if I do an adjustable rate, does that mean I am able to maybe buy a bigger house now?
Actually, under the purchase scenario, the fixed rate allows for less cash out. In my example, the adjustable rate loan, you would need $104,000 out of pocket. At an interest rate of 4.75, you need about $97,700 out of pocket, $97,700. On a 4.99%, you need about $96,700, and then $95,700 for a 5% interest rate.
Okay, so which rate do I need the least amount of money?
The least amount of money is a higher rate of 5.06% versus 4.99. So I would
Gotcha.
encourage my folks to take that.
Right, but and so if I had no heirs or I just didn't care about that particular asset, because it's not going to go against the rest of the estate. That's the thing, right? It's secured with the property, and so even if my other estate is doing this, I could have massive amounts of money in life insurance policies and other
Correct.
trust or whatever. And so this is my retirement house, and I'm able to basically buy the house for 50% essentially, and that's it.
That's
Right,
it. That's simple.
Man, I love that.
I do
Okay.
too.
Yeah.
Okay, let's say they bring the $250,000 up here, and it's with, they've got this pile of cash laying there. Who's going to help them with that? Magellan Planning?
Yeah, well,
Absolutely.
Absolutely. And then we can put them into a golf program or whatever.
Okay, so Kevin, what about our listeners out there? How are they going to find out if they qualify for a reverse mortgage?
Well, I tell you, Dan, what they're going to have to do is they're going to have to give you a call because we're out of time. Options Mortgage Services, folks, 678-482-1578, 678-482-1578. Speak with Dan McKenzie, and all you really need, I guess, is your name, your address, and your birthday, right, Dan?
That is it.
Somebody told me that.
It won't take 10 minutes to get you qualified and let you know what kind of cash you can get out or what kind of number you would need to purchase that home.
Yeah. And folks, we want to, sorry about that, Dan,
Go
but
ahead,
I'm going
bud.
to sign off here. Folks, we want to thank you for joining us again, and send us your questions, Kevin at MagellanPlanning.com. We'll try to just address those right here on the radio. And you've been listening to the Magellan Planning Hour, News Talk 1160, the talk of the town. Remember, people don't plan to fail, they just fail to plan.
You've been listening to the Magellan Planning Hour with Kevin Meaders, brought to you by Magellan Planning Group. For estate, financial, and tax planning, visit MagellanPlanning.com. Listen in each week as Kevin shares his wealth of knowledge about sound financial investment and preparing for retirement. The Magellan Planning Hour, Tuesdays at 1 p.m., only on News Talk 1160, the talk of the town.